Veena, thanks for being with us. Can we hear you now? We cannot hear you.
Okay.
Wait, I just heard you. Try it again.
Maybe turn your volume up, Veena.
I'm trying to dial in by
There you
phone
go.
while
There you go.
being on my computer. Can you unmute my phone dialing?
I can't unmute. I can only unmute your session, so you have to choose which method you're coming in by. I can hear you on the microphone. You just have to put it up closer to your
Okay,
mouth.
you can hear this okay?
You got to put it like right up, like
Want me to eat it?
yeah. There you go.
All right, I'll stay on this and I'll hang up my phone audio. I just thought it would be a little clearer.
I can hear you pretty good there.
Okay,
And
wonderful.
so let's talk about Neal. Neal is a principal/partner at Enzo Multifamily and has real estate experience that includes overseeing management of $250 million plus in real estate assets. Also a physician. This second calling in his life was ignited after successful passive investing in multifamily real estate. His passions involve investor relations, education, and empowering individuals with the proverbial seat at the table. So thank you for being with us, Neal and Veena. I saw some pretty exciting news on Facebook. You guys just closed on an Orlando property. Congratulations on that.
That's right.
We
That was
did.
Yeah, just flying in hot. I just got back about an hour ago, so if I fall asleep in the middle, you'll know why.
Oh, hey, that's exciting. Hey, that's good things. Good things. That's about 352 units. Was that right?
330, 24, 324.
52 million, right?
Yes.
Is that right?
Correct.
Okay. Yeah, great. That's awesome, man. That's exciting. We love to see success and growth forward, and I'm sure we'll hear a little bit about that here because you're going to talk to us today about asset management. That's a very important part of this. So, you have the deal finding, the touring, the underwriting, the submission of LOI, best and final, and blah, blah, blah. And then you finally get the one property that you won the bid on and you get it closed, and now you have to manage it. So you guys are going to talk to us today about that. Is that right?
Yeah, so I actually have kind of split this into 4 parts because I thought it'd be easier to kind of follow along. So the 4 parts we kind of divided it into is like pre-close, pre-contract stage, transition stage, then post-close, and then kind of like a bonus section with kind of miscellaneous things that don't necessarily fit into any one of those categories, but are kind of important to be discussed.
All right, that sounds great. Do you have a PowerPoint? Or are you just going to do it?
I do. I'll actually, let me message you a link so you can follow along. And then, of course, we'll share this with anybody that needs it afterwards. So, can I share my screen or how do I?
Yeah,
you can open your screen, however works for you.
No, share yours. So go down to the bottom to the green, the share, and then it'll bring up multiple options. You just pick the window you want to share.
Yep.
Then make sure you go into presentation mode on the PowerPoint once you do that.
Okay, I'm a total Luddite, so let's see how this goes.
You're not alone. Don't worry.
Okay, can you guys see my screen here?
I can see your screen. Part 1, Part 2, Part 3, Part 4. Yes.
Okay.
It's in a web browser format. Is that right?
Yeah, because it's in our Dropbox.
Yeah, that's fine. No, that works. It's all good. So I'm going to mute myself and get off my screen because people didn't come here to see me. They came here to see me too. So I'm going to do that. I'm going to be watching. Also, everybody, there's a link in the comments to follow along. I'm going to be watching the question and answer box. Make sure you guys are as well. But I'll let you guys take it from here and tell us what you got.
Perfect. Thank you so much, Brandon. Thanks, for putting together this conference. It's always fun. I spoke at it in January. We're excited to be here. So we put together this list. A lot of this is actually fresh in our mind from our closing from yesterday. So we'll probably add a little bit more color as we go because we're in the thick of it. So from pre-closing, once we get a deal kind of under contract where, we have an LOI accepted, the first thing that we do at Enzo is we create a war room. What that means is we put all partners, the seller, the broker, lender, and legal into our Dropbox. So we use Dropbox as our medium. I'm sure there's like 100 other tools that can be used as well. This is just our process and preference. And then we start categorizing it into various different rooms, folders underneath that. So we'll have one for broker financials, due diligence, leasing contracts. There'll be one for PSA, there'll be one for operating agreements, EINs, and we create subfolders underneath that. And we typically will copy and paste it over from the last deal to the next. And it's kind of a rinse and repeat cycle. Everybody knows where to find everything. It makes it a lot easier for us. The second tool that we really like to utilize is our Slack channels. We open a Slack channel between various partners of ours. So if we have other sub-syndicator partners or JV partners, we'll open a specific channel to them along with all of the Enzo partners so that they have complete access to us as we're going through the management of the asset and transition of the asset. And then the third step is our kickoff call. So our kickoff call, we get our whole team on the phone. So we get legal, we get lending, we get all the partners, and we get our title company on the phone to make sure everybody's on the same page. And during transition, this is actually a call. It starts right at LOI, happens again at PSA. We send out critical dates and critical timelines. And then we do it again, what would you say, Neal, like every 2 weeks we have,
at least maybe every week to week and a half.
We have a hands-on call with everybody. So then I will, do you want to kind of go into some of like understanding the underwriting and kind of what we look for?
Yeah, I think, obviously the first place to start, we want to look at the seller's T12. We want to look at potentially opportunities where we feel like there may be some small degree of mismanagement or maybe even potentially a better way to optimize operations. So that's a very important part of the underwriting. We want to understand expense ratios and know how we can find the opportunities. Obviously we want to very carefully evaluate the contract services. Obviously there's opportunities with things like cable contracts and things that are significant financial opportunities. Just depends on sort of the window in which you're purchasing a property to know whether or not you're going to be able to capitalize on that or not. But again, to understand if that's a potential, financial opportunity somewhere down the road. We also take very careful attention to which contracts are in place, what the lengths of those contracts are. Typically, we assume the majority of the contracts that are in place, but depending on the way that those individual contracts are underwritten, you also want to evaluate to see if there's a better opportunity or a better product that's potentially available in that window. In that regard, we always want to, since we're looking at that horizon as to how long we want to hold the property, it's also very important, when you're making that transition to evaluate the appropriate length for the contracts that you are going to sign. There's a lot of rapid fire contracts that have to be renewed and or issued separately, and it's very easy for a vendor to increase the length of that contract. And so again, you don't want to use sort of the speed of the transactions or the speed of the activity as being a reason for why you missed potentially a longer contract than you would otherwise want to. Again, looking at the technology systems, it's important during that PSA process to have a good understanding of what exactly is going to be left on the property, what is not, what is going to leave with the seller. From a technological standpoint, that's important in terms of security systems, telephones, computer systems, especially if there's going to be a change in the operating system or in the software that's utilized by the property management team. It's important to make sure that everything is compliant with the system that you're looking to put in place. Again, looking, I think the property that we just closed on yesterday it's fresh on our minds, and so maybe this is just a good example. But we, as we go to the next area, payroll, we, spent a lot of attention and time to that, and looked at that as an opportunity. Obviously for example, this is a $52 million asset in Orlando that we felt was overstaffed for the needs of the community. And so it provided us an opportunity to attract very qualified leaders in that submarket at a price point that was probably higher than what they were used to receiving in exchange for potentially maybe downsizing the overall staff that's on site. But again, as it pertains to the property, that's an overall win for us and for the investors, because we've decreased our operating costs. I think it's very important to kind of get buy-in and get a real assessment from the people that are going to be on site, who are going to be the boots on the ground, to making sure that they're not becoming overburdened with the tasks that are at hand, that there's adequate staff to account for vacations or people being sick or leave or any of those different things. But at the same time, it's not overstaffed to the point where everybody's not being optimized to their full potential. Utilities are kind of a little bit, Rubs, or maybe your specialty a little bit more. I'll let you kind of maybe go on that one.
Yeah, so I think, and this is something that's obviously really market dependent, but in our markets, we're seeing penetration success under our management as high as 98%. So 96 to 98% is very, very doable. So when we're looking at the T12, we always want to look, when we're going in, where are they at currently, and why are they not high enough? Is there no opportunity there? Is there something unique to the property that there's no opportunity there? Can we create an opportunity there? So overall, when you're looking at underwriting, I mean, we're always just looking for opportunities for improvement, not just on increasing the income, but also for decreasing or maximizing efficiencies on the expenses side. So you have to do both. You don't want to focus on either one too heavily, is what I would say. And actually, to piggyback on something you said about staff, Neal, we like to follow the model where we compensate our staff and our employees a little bit better than what they're expecting, because it gives them a lot of buy-in to us as a team. And everything you guys will see over and over from Enzo, everything is everything is a team, everything is ours. We win together, we lose together. And so it's very much a team mentality, and our staff absolutely follows that and kind of buys into that family perspective as well. Yeah. I mean, just to drive that point home, I mean, yesterday when speaking to the property manager on site for the property we closed on, really one of the themes of the conversation I had with her was that the incentives, the bonuses that we put in place to sort of mark successful operations, we want to have them there really on a real-time basis, so that they can see the fruits of their labor in real time. We try and incentivize our employees on a monthly basis to make sure that they are rewarded for their actions, are rewarded for the overall performance of the property, to make sure that they understand that the support that's available from the Enzo multifamily team is there to help them achieve those milestones. And then we also want to look at things on a quarterly and semi-annual basis to really further incentivize and make sure that they're hitting their marks on the different parameters that are in place. Again, we want to set the benchmark that's to be obtained. We want to set that benchmark at a very easily obtainable level, so that it's a marker of excellence, but at the same time it's very achievable, and that in itself is not too stressful for the person trying to accomplish that goal. Totally agree. So kind of in the pre-closing due diligence side of things. I know we haven't even closed the asset in this theory right now, but there's a lot of work that goes into the asset management side of things before we close the asset at all. So the first thing that we do when we're starting our due diligence is we have our roofs, our building systems, so that could mean boiler and chiller systems, that can mean plumbing, structural, environmental, any deferred maintenance, all of that, at least Enzo's model is that we like to have all of that executed prior to our PSA execution. We actually like to do it before going into the best and final round on our LOI even. So we do put out capital up front early on, but when we put out that capital, it allows us to go into LOIs and PSAs knowing that we have 90 to 95% of our due diligence complete, and we have a solid idea of what we're looking at in terms of takeover, what our budgets are going to be, and what we're going to be coming up against with regards to our CapEx planning. So you'll definitely want to budget for any potential issues that come up in these inspections and third parties, and also make sure you have contingency budgets, especially as we cycle through a market. Once we start getting into a downturn market, you're going to want to have capital reserves to be able to address any issues that come up. The last thing you want to do is capital call investors when the market's down. It will not be fun for anybody, so make sure you have large contingency budgets. We also, one thing that we pride ourselves on and that we do, we've actually recently started doing this probably in the last 6 to 8 months even, is we've brought in a risk management team specifically for all of our assets. So this is where we start involving risk management. We make sure that all of our insurance coverages are done properly. We make sure that we have maintenance programs in place as necessary. For example, if we know that there's a roofing issue, we get our roofing contractor out there and we get him to quote us on a maintenance program to make sure that, those roofs are being repaired as needed to ensure that there's no additional damage. You may not be in a flood zone, but it may be an asset that requires flood insurance because of the potential risk for it. So this is where we have our risk management team do a whole cost benefit analysis on whether or not outputting $5,000 for this insurance coverage actually makes sense and mitigates the risk enough for us. So and throughout this process, when you're working on your budgeting, you're going to work closely with your lender. You're going to work closely with your underwriting team. For us, that's Sapan. He's our other founding partner, and your property manager, if you have one. If you're using third-party property management or if you're doing it in-house, you want to work very closely with these various people because they're all going to have input into what is achievable, what is realistic, what's currently happening on the property, and how to implement what we need to happen on the property. So you're going to want to over budget from the seller's T12 on expenses. So, you're going to want to look at marketing, for example. Do you need to do a brand refresh? Is that going to cost you $25,000? If you don't use that $25,000, okay, that's fine. You can reallocate it to somewhere else on the asset, or it's just money you've saved on the asset, but always have enough of a budget for those. And then under budget on the income. So if you're planning on doing 6 different amenity plays on an asset, you don't want to go in there underwriting at 100% across all 6 amenities being at full ROI in year 1, right? So you want to be very conservative on what you're adding for additional income. And you want to be able to discern which revenue generators you actually can realistically implement. So what that means is, are you going to be able to get $200 in a Class C asset for a pet yard? Probably not. But are you able to do that in a B or a B plus asset? Potentially. Do you want to underwrite to $200 across every single unit? No, absolutely not, because not every tenant is going to have a pet and not every tenant's going to pay for it. So you want to make sure that you're being realistic in what your assumptions are here, because this is where your underwriting can really make or break the asset management team, because asset management is relying on underwriting and finance to give them a realistic budget so that they can execute the vision. does your market call for concessions? Are there concessions on the T12? If so, why are there concessions? A lot of the markets that Enzo's entering right now, we're not in a concessionary market. So is this something that sellers are using to artificially inflate numbers prior to going in? Can we burn the concessions off of the T12 very quickly? Are we going to leave them on? Do we want to leave them on? Is there a psychological marketing play here that we raised rents by $50, but we're giving you a $30 concession? So really we're gaining net 20s. So there's a lot of reasons to look at concessions, and you just want to understand the reasoning behind them. Neal, I don't know if you want to add anything to.
Yeah, I mean, just to summarize and kind of drive home some of the points that were made. I mean, I think the key here is conservative underwriting, and I think that this goes to one of the fundamentals of multifamily investing in real estate that that deserves some attention. Is that it's not only for the viability of the project, but as a fiduciary and from a fiduciary standpoint of creating a realistic expectation for our investors. I think it's critically important to value having conservative underwriting over having higher returns or a more impressive IRR or any of those other parameters. I think our investors respect that, they appreciate that. And so I think that it allows for a little bit of a glimpse into a sort of, not a worst case scenario, but at least some inclination to a little bit of a downside. I think it creates realistic expectations. But I think more importantly, once your reputation's established, it also provides you the ability to exceed expectations and to consistently produce at a higher clip than what you're presenting. I think you develop your reputation very quickly as an operator, and the N is one for everybody too. Is that I think that again, in terms of if there's a project that's upside down or there's one that's underperforming, that's always sort of a mark on a sponsor's back, so to speak. And I'm proud to say, from our company standpoint, that's never been the case. We've never missed a distribution that we've looked to make, and I think most of that is attributed to, number one, finding the right asset, having the right operational team in place, but secondarily and potentially more importantly is conservative underwriting. And so, again, as an example also, I mean, when we went for this last property in Orlando, the lender came back to us and said that our underwriting was too conservative in terms of our occupancy. And so, I mean, as an example, that property is sat at 98, 99% occupancy for the last, 9 to 12 months. And we underwrote it in the low 90s. And that was, again, something that the lender wanted us to amend because they felt that that was too conservative in terms of our viewpoint. But as far as, our perspective, we want to present, a true test of the property to make sure that it could stand against a little bit more difficult economic situation or any substantive change. And I think that the investors respect that and they appreciate that.
I agree. So pre-closing, as we're putting kind of business plans in place, and Neal, I know you very much are involved in all of these processes post-close as well. These are some kind of low-cost, high-yield ideas that we have seen success with across various assets of ours. With the first and probably one of the most obvious ones being reserved parking, or parking in general. So there's different types of parking. One is obviously reserved spots where literally it's a stencil and a can of paint painting reserved parking onto the parking lot and getting anywhere from $10 in some assets up to $20, $25 in other assets. We always look at covered parking, whether we can put up covered parking and will we be able to see maybe like a $25 to $45 premium on that. You can take that a step further and go to like garage parking where it actually closes. There are storage areas in there. If you are in an asset that has minimal storage space inside the units, this can be a huge revenue generator. And one of the things to look for as you're walking the property during due diligence is what kind of cars are out there. Are you in an area like I live in Dallas? We have hail here all the time. So people are willing to pay to keep their $40, $50, $60,000 car hail free. So can you get $50, $75, $100 for garage parking? And then one of the models that we are working on implementing on the asset we closed yesterday, actually, is our on-demand parking pricing. So this model is a model where we are going to start charging based on, well, it's kind of like a tech geeky type play, but based on how close the parking spot is to your front door, the parking will get cheaper and cheaper as you get further and further away. So basically, how much are tenants willing to pay for convenience? So we're going to start kind of testing that model and seeing where we can really push that. We believe that some tenants will pay as high as even $45 per spot for the spot right outside of their front door, so they don't have to walk with kids or groceries very far. So that's kind of a newish model that we're implementing. We think it's going to work well. We just took over the asset yesterday, so we'll know here probably the next couple of months how that works. And this is also a really good area when you are leasing. Neal, correct me if I'm wrong, but this is one of the first areas that we offer our quote-unquote concessions, because there's not an expense on the other side of it, but the tenant feels like they're getting 6 months of free reserved parking, and then it turns into a revenue generator after that initial term expires, right?
Absolutely. Yeah, it's about creating the infrastructure, creating the system, putting that in place so that becomes the expectation of the community, because it's also, there's a certain domino effect to things like parking where, all of a sudden, if the 5 closest spots to my to my unit are now occupied by reserved spots, it creates more of a demand for me to be able to also do something similar. Otherwise, I may be parking at the next building, or I may not have a reserved spot when I come home late at night. So again, it's about creating buy-in from the community, and integrating the system. And so sometimes that does require a concession or along those lines, but it also gives the resident an added opportunity to experience it, see if they enjoy it, see if it's something that they would want to continue, hopefully when they renew their lease.
Absolutely. Create the habit out of the gate.
Correct.
So then the next one that is probably one of my favorites, but that's because I'm a dog lover, is the pet amenities. It's typically in our assets, it is one of the top 3 searches done by tenants in the communities that are in areas we operate in. So it's really important that we have, pet friendly advertised. We have a dog park. I think all of our assets actually have a dog park. You can put those dog treat vending machines up. You can add some obstacle courses fairly cheaply. And we've had pet washing stations at some of our assets, which have been basically, it's like a hose and an area for the dog to be. But it seems to be kind of a hit with a lot of our tenant base. And then also, on one of our assets in Jacksonville, we have a local mobile groomer who brings her truck, I think it's once a month, and she parks in the parking lot and she provides mobile grooming, and our tenants love it because they take their pets there, they get them groomed, washed, everything. They don't have to leave the convenience of their community. It's 0 expense for us because she's bringing everything and she's getting her business. We're supporting local businesses. So don't be afraid to partner with local resources or community resources on your amenities to save money on your T12, number one, but also create that community feel for your tenants in your asset. Do you want to talk about the gym?
Sure. I think we also had a question. So before we get too far away from parking, Ruben asked if we rented out space during the day for local businesses. So in our assets, they're not necessarily integrally associated with other local businesses. I mean, I think you have to look at it from two different perspectives. One is from a liability standpoint, do you want to create the pattern or the habit of having people that don't necessarily belong to the community to, actually be on site on the perimeter? And that may become a slippery slope, because then, you may also include or incur traffic into other common areas or amenities that you wouldn't otherwise want on your property. So the short answer to your question is we have not integrated that into our business model on those on our assets, and I wouldn't personally be inclined to doing so for that reason. Obviously, I think one of the other key points is that each asset is so individually different, and so really you have to evaluate each asset as it's on its own. These are there's only experience and parameters and advice that people can give you, but each community has its own history. It has its own personality. It has its own quality of people that are used to sort of the way of life there. So you don't, as a new operator into a system, want to reinvent the wheel or force the community to sort of adjust to your model. I think it takes the ability to be flexible as an operator, to be flexible and make modifications to your model to accommodate sort of the personality of the property that you're serving and the residents that you're serving. So in terms of the gym, fitness, and lifestyle, it's very common, again, to refresh the gym with either new equipment or sort of added facilities, and so we like to add things that allow for yoga classes to occur. We want to make sure that the equipment has been updated, that's in good working condition. And so these are important, not necessarily revenue generating amenities, but things that are attractive to residents as they come, and also for the people that do utilize those resources, it's an opportunity to increase retention. So we always want to make sure that again, the gym has all the necessary amenities for the residents. The property we just closed on, it has actually has a tennis court and a real resort style pool. And so again, these aren't amenities that we have on all of our properties, but while they're not utilized every minute of the day or as much as maybe you would even like, we try and find ways to incorporate that into building the sense of community. One of the ideas that we had discussed as we're taking on this property is in better utilization of the tennis court. I mean, it's a beautiful part of the asset that people love to look at, but not oftentimes is utilized very much. And so one of the ideas we came up with was to hire a tennis instructor to come out there, once a week, 7 a.m. till 8 a.m. Whoever wants to take a free tennis lesson or maybe even a subsidized tennis lesson, it'd be available to them. And, the hope from that would be that, maybe groups of people would come together later and play tennis together, or new friendships would develop, or, the community can help to grow that way. So it's about utilizing the culture that's on site and trying to blend that with the amenities that are there to create the greatest sense of community. And so, again, while everything is not going to necessarily be a revenue generating opportunity, oftentimes, by building that sense of community and increasing the experience that the residents are able to have on site, it translates to financial success for the property in multiple other ways.
Awesome. Yeah, I totally agree with that. Okay, I know this is one that you spend a lot of time looking at, and I know you've looked at like 100 different models across all of our assets. And it's the laundry room, right? So every asset we buy, I feel like this is one of those areas where we spend a lot of time looking at what's already there, what we can do there, how do we do what's there, how do we handle the current in place contract, how do we terminate it. Um, so do you want to maybe kind of hit on some of the best practices in laundry?
Sure. I mean, we have across our amenities a wide range of business plans as it pertains to laundry. And that goes back to the point of individualizing your plan for each individual property. So you may be in a community that, relies on having a laundry room, and that's really the best financial option for them. And there are not washer dryer hookups in all the units, and that system works for the community that's in place. And so walking into that situation, unless you're going to undertake a radical, capital event to, change the insides of the units and really drive the unit prices, you may not be able to necessarily change that part of the business model. We have other assets that are in that intermediate range where people do have more financial flexibility and they're willing to pay for the amenity of having a washer dryer in their unit. And so then you come to the branch point of, well, do we purchase the units, or do we lease the units? And I think, again, both of those should be tailored to the individual situation at hand. So the benefits of being able to, own the washer dryers by the complex. Obviously, all the revenue that's generated into, from that perspective would go directly to the property. There wouldn't be any profit sharing in that regard. You'd also be able to, potentially utilize, cost segregation in terms of some of the capital requirements, or at least offsetting some of the capital requirements for that type of project. In some of our other assets, we actually, in fact, will lease the units from a third party, and potentially take 25 to 30% above what the lease rate is that we're paying as a income to the property. And then finally, we even have an asset where we have units inside the property that are on that small to medium size, and we will provide additional resources on site for larger washer and dryers so that people can do their sheets, their blankets, comforters, or potentially a very large load if that's what the resident chooses to do. So I think, again, finding the individual solution for that property is a decision that has to be carefully evaluated. It has to fit with the culture of the property, with the history of the property, and also the direction that you're looking to take the property.
Yep, I completely agree with that. And some other income ideas that we've used or looked at, valet trash is another big one. We have outsourced it in the past. It's absolutely one of those easy amenities to bring in-house, and to kind of see a little bit more pop on the income from that. Amazon parcel lockers, I'm sure you guys are seeing those pop up. I was at my local bank the other day and saw Amazon lockers in there. So definitely something that tenants, especially in apartments where they're not allowed to have packages delivered to the front office, we don't want the liability or responsibility for them. It's a great way for them to still get their deliveries without having to worry about it being on a porch in a high density community. Co-working spaces. So this idea is kind of was born within one of our assets we closed earlier this year in Jacksonville. We found out that we have about 50%, 60% of the residents work from home. It's right on the beach. The tenants live there to be near the beach. They work from home. We have a beautiful clubhouse. Nobody uses it. So one of the ideas that we are working on implementing is putting in co-working spaces. There's no large co-working provider in that area, so they have no virtual office that they can go to. And so that's another income generator that they will have access to, you know, food, refreshments, conference rooms, high-speed Wi-Fi, printers, just like you would see in any of these other co-working space setups. And then in our Florida markets especially, we're seeing car washes that have been a huge hit with the residents. You know, and that can be as simple as putting out next to your pet station access to water, some like car wax towels, paper towels, a vacuum, and it's a very low cost idea. You can absolutely monetize it, or it can be one of those low cost implementations that just makes it a really nice amenity that attracts better quality tenants who are willing to pay more on the rental side, and even if it doesn't impact your additional income line. So that's kind of what we look at pre-closing. So we're looking at the bigger picture, what we want to do with the asset, what we can do with the asset, and that's kind of how we come up with our projections for investors. Our offering memorandums go out based on all of this due diligence that we've done pre-PSA, pre-closing. Now, during the transition period, we start taking a deeper dive into everything that we had just looked at. So that's kind of more like pro forma speculation. Do we want to do this? Why do we like this asset? What can we really achieve here? During transition is when we start kind of, you know, the rubber meets the road here. So we actually start looking at T12s, we start looking at financials, and we start getting the wheels in motion for our business plan. So Neal, do you want to hit on kind of these two?
Sure. I think, you know, taking maybe even half step back where we go to that pre-close and into that transition period, you kind of get a sense of the community, also who the seller is, are they a individual seller who doesn't have a large footprint in that area, or is this a larger company that has multiple assets in the area? So again, those types of different sellers may indicate a higher proclivity towards you know, employees wanting to stay versus you know, going with the management company that is already in place. So you know, you're kind of getting a feel for those things on that initial evaluation when we do our due diligence, when we're, you know, asking questions about the property. We're seeing what you know, individual employees' IQs are as it relates to you know, dealing with new people. Do they seem like that they would be the type of people that we would want to be in charge? What we found oftentimes is that you know, again, with the when sellers don't have large footprints in those areas, and there's obviously a higher likelihood for those community property managers to want to stay alongside the property. It's obviously very common for managers to develop very intimate relationships with residents, and that's something that, you know, you want to evaluate along the way. Does it seem as though that the property manager has a great pulse of the property, that they know the majority of the residents by name, they know their habits or their personality traits, and they're able to you know, kind of give that kind of insight? And that's obviously indicative of somebody who's invested into the property, maybe emotionally, or maybe they also live in the near proximity. So you know, those are parts of the consideration there. You know, when you're encountering a situation where you're dealing maybe with a larger management company or a larger operator, and the employees are more likely to leave, you know, again, it's important to see if maybe there's somebody along the management team that's sort of a rising star, that's a rising leader, that can fill the shoes, that has seen the example that's been put in front of them, but is potentially looking for that opportunity to move upward. And so we've found that in a lot of our assets, and I think oftentimes it's one of the I think either solution is a great opportunity for the new buyer coming in. It's just, it takes an emotional intelligence to sort of establish that relationship and create that common vision of growth, and create vision of trying to help foster that person's both financial as well as professional growth, and being a facilitator of that is another sort of fiduciary responsibility. So, one of the things that we look towards when managing a property is to help sort of bring people to the next level. So from our property management team, we want to continue to see, professional progress from our employees, so that they're moving in an upwards trajectory, that they're able to hit their bonuses, that they're able to move forward with their income and help support their families. And at the same time, the trade-off that we as Enzo Multifamily get is obviously somebody who is committed to us, that when we sell an asset, or potentially if we have a new responsibility, to ask of them, that they're more than willing and able to sort of step up to the task. It also helps us to create an infrastructure where we're able to utilize our employees towards cross-training into our newer assets. So we're able to allow our property managers to be a resource for new property managers, whether that be software integration or management-related questions. Again, we have a very detailed sort of playbook, but not every scenario can be covered. And oftentimes, having experience with the same situation, coming from property manager to property manager, is a much easier resource to allocate than every time there being any kind of discrepancy or concern. If they were every time to reach out to us directly, we wouldn't have the bandwidth to accomplish that. So I think it's about creating a culture. It's about, again, as you expand across multiple properties, it's about creating additional resources to help everybody to be able to support the bigger team as a whole. I think, again, when it comes to evaluating who you want on your asset when you come in, it's important to be flexible sort of with, payment structures, I think. Again, losing a primary resource to a property, somebody who's known the property for multiple years, or known the residents for multiple years, is in itself a great asset to the property. You want to make a transition across different property management teams as seamless as possible. And, again, red flags that residents and communities see is if there's changes in community managers, or there's substantive changes right away. The more successful transitions are the ones that the residents hardly notice. And so those are the ones that we strive to accomplish. We also try and do things right away to improve the quality of life or the experience for the residents right away. And that may include things like we discussed earlier, like valet trash. Those are things that in most communities, the residents greatly appreciate. And once they experience it, they almost can't remember a time where it wasn't there. But when that's added to the asset, essentially at no cost to them, when we take on the property, that's something that most residents truly appreciate and see as a huge value add for them. This again goes back also to very diligent underwriting and very conservative underwriting with reserves. So you always obviously want to consider your budgeted payroll very carefully, and while making those offers, making sure that you're compensating people appropriately for the scope of work that they're going to be tasked with. But you also obviously don't want to put the pro forma under pressure by overpaying for payroll related issues.
Yep. I agree. And then with regard to utilities during the transition, I mean, this is always a lead time issue. So you want to start getting utilities set up very quickly. If you're taking over a larger asset, there's likely going to be a deposit. You can get a surety bond in lieu of a deposit. Again, lead time issues, so make sure you start that right away as soon as you're under PSA. You'll want to apply and set up any permits necessary if you need like a business license or a COI, or if the city needs to inspect and issue you guys permission to be a landlord tenant, you want to look into what your local ordinances are. And I know we only have a few minutes left, so we're going to try to breeze through some of these a little bit quicker. So as far as contract services go, your PSA should already have dictated which contracts you have to assume. There's going to be certain contracts you absolutely cannot break. Then there's going to be some that are, take it or leave it, but you need to give proper notice. So which do you want to keep? Which do you want to cancel? This is a time to renegotiate if you have a contract coming up and you want to keep using that vendor. This is where you can start renegotiating your terms. You'll also want to use this transition time. So this is kind of the period of your IP or due diligence, and then your financing period that you're using to get this closed. You're going to want to start on the website and tech side of it. Getting your back end built out. Are you going to have a standalone website? Are you going to put it on your website? How are you guys marketing the property? Start getting your tech team building that out. Are you going to take over the prior property owner's tech? You'll want to start setting up your resident portals and all your tech vendors. So what package are you going to use on apartments.com? Are you going to use Rent Manager? Are you going to use Paylease? What's going to be the tech packages that you're going to implement across the property? Hand in hand with that is your social media. You'll want to get that obviously set up, or at least have a plan for transition post-close. And plan to install brand new phone and computer systems, especially if you're taking the asset over from a more institutional seller, because they're likely going to have phone and computer systems set up there that are integrated into their entire network, and they're not going to leave them. They're going to want to take them with them because they're already integrated into their systems. So plan to have new phones and new computer systems. That's one that gets overlooked a lot. We've missed it sometimes too in all of the busyness of closing. So just something to be aware of. And then during the transition period, we also are continuously conducting audits. So what we do is we always ask for a weekly rent roll, and we ask for updated T12s quite frequently during this process. What we're looking for is to make sure that the current owner is maintaining the asset to previous standards that we agreed on. Again, this should be written into your PSA, but you want them to continue maintaining the asset at a reasonable operation level through this process, so that you are taking over an asset that you had agreed to buy 60 days ago. And in that, you're going to want to start doing your lease audits. So when are your leases expiring? Are you going to close on an asset and then have 20% of your leases expire the next month? Are you going to have 10 new renewals where they've given tenants a $500 rent concession that you don't know about? So you're going to want to make sure you dive really deep into this lease audit. How many NTVs are coming up? Are there notices to vacate? Are there 10? Are there 5? Have they renewed any of them? Are they renewing them at market rates? Are they renewing them at their previous rates? Those are all questions you want to ask, and you want to continue watching occupancy, because this can affect your financing. Freddie and Fannie don't like to see big deltas or changes. Especially if it's on a smaller asset, one vacant unit that you weren't expecting can make a huge difference in your occupancy or vacancy rate. And then you'll want to, get all of your leases uploaded into electronic formats if they're not already done. Properties from about 5 years ago, we're seeing some of them have electronic leases, some of them don't. It's 2019. It's time to get onto electronic leases. And then you're going to want to continuously do a T12 audit. So you're going to want to deep dive into your expenses and income. We'll sanity check numbers. If we see anything out of line, we start asking why. For example, we may see an unusual plumbing expense. Well, did a pipe burst somewhere? Is there a major leak somewhere? Why are we seeing that expense? And so we'll start checking for backup and invoices along with that on our T12s. So this is all part of the asset management, because we want to make sure when we're taking it over, there's not some kind of a surprise about, oh, okay, well, here, now you just closed this property and there is, a septic leak somewhere, or, there's galvanized plumbing that now is going to cost you $200,000 more than you had budgeted for. So that's why we look for a deep dive on the T12 audits. And then going to kind of the third part, which is post-close. And this is the phase that we're in the thick of right now on the asset from yesterday. Enzo, I feel we are probably one of the more hands-on operators. Neal is our in-house asset manager. He does an awesome job, and I'm so grateful he does it because I do not enjoy operating nearly as much as he does, but he's very analytical. He's very good at it. And one of the things that we pride ourselves on is always being hands-on on our assets. It may seem, overkill or a little frivolous, but we know everything that goes on our assets. And we really spend the time, and by we, I mean Neal, really spends the time doing all of this on not just a weekly basis. And I know that this says weekly because it's kind of realistic, but I know, Neal, you have conversations with our property managers even daily across our assets. You know everything that's going on, from where they're going on vacation next week to how many leases they've signed in a week. So I don't know if you want to kind of go over what your weekly formal conference call is like, and then maybe we can talk about what we do on a monthly or quarterly call.
Sure. Yeah, I mean, we like to do our property management calls early in the week, typically not Monday. There's just enough things to catch up on. It gives the on-site people a chance to prepare the report that's going to be discussed on typically Tuesday or Wednesday. It allows us also to be able to, in real time, make changes and adjustments that can affect the week that's ongoing. During that weekly call, we discuss the major parameters of the property. So that's going to be, what the occupancy is, what the 30-day pre-leased is, what the trend is. We evaluate and make sure that the rents are being collected. We also want to look and give this as an opportunity for the leasing agents to share what their closing rate is. So that's an opportunity to provide some feedback, to provide some encouragement to those that are doing well. And, again, maybe some pointers or some, advice for people that may be struggling. We want to see where our leads are coming from. If it's all coming from, drive-by visits and it's unqualified traffic, is there something that we need to adjust in that regard? Is it all coming from virtual sites? Is it coming from apartments.com? What's exactly the source of the leads that are being acquired? This also ensures us to know that there's continued traffic that's coming to the property, that's able to allow the business plan to be implemented, to allow the replacement of people that have provided their notice to vacate. So those are the basic parameters, I think, that happen on most property calls on a weekly basis. But I think really the secret sauce, and may not give it all away, but is to keep that connection more so on a daily basis. And so I think every other day to every day to every other day, whether it be a personal or sort of a professional call or a touch in, I think it's nice to be able to provide that to those community managers. It shows them that you're engaged with them, that you're there by their side. It gives them an opportunity to potentially discuss a potential problem before it becomes a problem, or to again get potentially 4 or 5 days lead on a situation, so that you're able to have the right resources in place. So I think it's very important to have that connection with the primary boots on the ground, and so that's a responsibility I take very seriously. So that's what I would say about that.
And then we do a monthly call. Usually either Sepin or myself will hop on a call with you and with on-site management and the entire team to talk about the monthly financials once we close out the books for the month, that following month. And we actually go through every asset line by line by line. And if we see any delta, positive or negative, we spend time diving deeper into that. And I think a lot of investors and or other operators are surprised that we spend time on the positive deltas, but the reason we do that is because it tells us what is working in our submarket. So it allows us to implement strategies portfolio wide and boost the entire portfolio by understanding like, hey, this works really well in Jacksonville. This works really well in Orlando. Let's go ahead and rinse and repeat on the next asset. So it allows us to fine tune our processes, our systems, and what we are really able to do on the next asset or the next target or acquisition. This is also the time, and I think probably one of the things we spend a lot of time on is reallocating the GL entries. So a lot of times what you'll find is something will be entered under painting and supplies or plumbing or make ready, when really this is part of the renovation budget, so it's a CapEx item. So if you underwrite the way we do, where it goes below the line, you'll want to make sure you're allocating CapEx expenses appropriately. So for example, if you're doing like a full reno from a classic to an upgraded unit during a move out, let's say this month in June, you want to make sure that your $1,000 for painting isn't going under your make ready budget, but it's actually coming out of your CapEx budget, because that is it's gonna tell a different financial picture, and it's gonna show inconsistencies if you don't actually discern between the two. So that's where you're going to want to go through and make sure you're doing your reallocations as needed. And then, I mean, the other thing not to be overlooked, a lot of our loans are Freddie Green Up or Fannie Green Up loans. And on those loans, there are certain requirements needed. You know, they give you a list you can choose from of how you want to maximize energy efficiency as well as water efficiency on your asset. And you do need to upload reports on that. I think it's monthly, we upload them. And then you do have a deposit that you get back, but this can affect the basis points on your interest rate if you're doing a Fannie or Freddie Green. So it's very important that those requirements are being met. Also, if there's any Fannie or Freddie requirements or conditions for post-close. So for example, on one of our assets, we were required to install an ADA compliant sink. So in order to do that, they held back reserves. We have to show them proof that we actually made the change. So those are things you want to be aware of. Those are in your loan documents. So make sure you're paying attention to those and you're getting them done in the proper time frame. The last part is kind of like a quick bonus section where these didn't really fit into any one of these. So this question is kind of, and we've had this happen before. When your third party property management isn't making the cut, what do you do? You know, sadly, we've terminated property management before. We've had to just kind of go our separate ways because they were not meeting our standards. And because Neal is so hands-on on a daily, weekly, monthly basis, thankfully we were able to kind of see those trends early on and start moving away from that property management company right away. So that's, I mean, if your property management isn't making the cut, this is who you're relying on to operate your asset. This is who you're relying on to make your financials work, to keep your investors being paid, to make sure you're making your debt service. And so it's very, very important that they are up to snuff and they're meeting their budgets. We always like to ask them why they're not hitting budgets. If they're missing it somewhere, if they're missing a line item, why are you missing this by 3%? Why are you missing this by 5%? What do we need to pivot to make sure we get there? And if they still can't meet it, then, you know, it's not the right asset, not the right fit. And then that also ties in with regards to certified documentation from the seller. So whenever we're negotiating a PSA, our attorneys will always negotiate for a rep on the property. So we always ask for a certified T12 and rent roll. So basically what we're asking for the seller to tell us is, hey, this is accurate. This is what we, you know, are putting into our books. These aren't you know, made up numbers. They're as accurate as we can possibly have them. So you can absolutely ask for that. You can ask for a lot of reps. You can ask for a material defects rep. You can ask for structural. You can ask for no known leaks. And a lot of sellers, especially in this market, are going to push back and say no. But the certified T12 and the certified rent roll, I think, for us at least, are kind of the hills that we are willing to die on when we're negotiating, because Fannie and Freddie are going to require those eventually. Neal, do you want to kind of talk about the roles of third-party management and how we've utilized them in the past?
Yeah, I mean, from a due diligence perspective, obviously you're going to be going through the units. So, I mean, careful, execution of that process of, taking pictures throughout the units. Again, having multiple resources on site is very helpful. I mean, you don't want to be doing this by yourself, inconveniencing the residents and the properties for long periods of time during that process. You want to, again, keep this as seamless as possible, keep it as professional as possible. So again, even if you need to allocate additional resources to making that process move faster, I think that makes an impression on the community. It is less burdensome. And as you're creating your reputation as a operator, it's important to be respectful to the community as you're going through those units, looking at them as property, where other people look at that as sort of an invasion or an inconvenience into their personal space. So you want to be very cognizant of that, to be able to do a detailed evaluation, but having adequate resources to be able to do that in an efficient way and in a very diligent way. In terms of budgeting, again, it's important to share pro formas and budgets and expectations with the property management team, with a third-party property manager. It's important to hold them accountable for that. So again, you're able to do so on a smaller basis based on weekly evaluations, looking at expenses, and definitely on the monthly basis, coming through the financials in great detail. But it's not uncommon for groups to just sort of look at bottom line numbers. If they're sort of in the ballpark, they kind of go with it. But again, you may not recognize a sinkhole or a potential revenue leak that's been happening if you don't go through items line by line with the property management team. It's obviously, if you're not accustomed to doing that, there's a certain art to it, and there's a certain level of knowledge that you'll develop along that way. But there's, again, as an operator, and if you're an inexperienced operator or first-time operator, it's important to be educated and to ask questions and make sure that you have clarity in terms of what exactly those expenses are being allocated towards. Again, the property management team and the investment's best interests may not always be aligned, and it's really your responsibility as the holder of those two parties to find the best compromise and to make sure that the investors are being protected in the situation. You also want to make sure that the business plan is being executed, that you're evaluating to see, well, our renovations, are they on schedule? Is our economic vacancy, is it being impacted too dramatically because our turns are taking too long, or our renovations are relying on too many different vendors, or the costs are coming out higher than we anticipate. So either at that point you need to alter your expectations or alter your budget, or again, alter the business plan, potentially holding other people more accountable or finding alternative solutions to being more efficient with the solutions. And finally, again, I mean, being well capitalized with conservative underwriting is really, I think, the theme that has made us very successful along the way. It provides you a runway to occasionally make a mistake. You're not going to be perfect. You're going to be learning from experiences, so that the next time that situation presents itself, you can be, you can potentially even anticipate it before it's going to happen. But oftentimes it takes at least going through a negative experience once before you can truly sort of understand the cause and effect and all of the different parameters around an experience. So having, again, great reserves per door and very realistic and conservative underwriting is critically important to a successful project.
Absolutely. And so that kind of like wraps up everything. I'm sure there's probably other questions that'll come up that maybe we didn't hit on, but we're happy to answer questions and share our experience. Um, if you guys go to our website, enzomultifamily.com, there's a button Retire in Luxury. If you guys click that and just put in there, like in the other form that you were at MFIN and you want a copy of this PowerPoint, we'll get this sent over to you guys so that you guys can take a look at it and go back through anything that we missed, and we'll be happy to answer any follow-up questions or anything like that from you guys as well. Brandon, I don't know if you want us to turn this back over to you.
I'm here.
All right.
I just posted your web address there in the
Awesome.
comment section. So if anybody wants to click on that, they can go there and get in contact
Yes.
with Veena or Neal, and they will get you a copy of that. So a lot of information there. That was great. I mean, it's, I guess a lot of people don't realize, if we have any newcomers or people who are looking to get into this, really what all is involved in trying to find forms of revenue inside of a property. We talked about this on another episode about, small things make a huge difference on property value.
Yeah.
And, a lot of people talk about cap rates. And, one thing we've always talked about is, honestly, if I buy a property at a lower cap rate, if I save money on an NOI, I get a higher return for that savings on a lower cap rate. So low cap rate is not always a negative thing. It can be a positive thing. It's just about your exit cap rate.
I totally agree. I think that investors focus on cap rates so much without knowing why they're focusing on it. It's a theme we see all the time because people love to talk about cap rates without knowing what it means. And so, it's something, especially being investor facing, that I'm like, okay, well, what do you want to know by understanding this cap rate? And really what they're asking about is how we're looking at the deal. They're not actually asking about the cap rate specifically, because there's so many. There's the seller's exit, there's your entry cap, there's your operating cap, there's your post renovation cap, there's your exit cap.
Right.
So everybody's calculating it differently.
Exactly. Yeah, we've seen T12 cap rates that sub 3, and because it was operating so badly,
right?
Or, they had horrible bad debt, and or you lost the lease.
Yep.
So, those types of things that don't affect it. But, just those things that you were talking about, like trying to find revenue, or, Neal was talking about, washer and dryer units, whether you own them or lease them, there's pros and cons to both. There's pros to owning because you get a higher revenue share there, but you also have to maintain those, and you have to fix them if they break. And, so it's a trade-off, and, so it's great for you guys to give this content. We do have a question. Can you see the question and answer box?
Let's see. Going back to your contract services, I hate dishnet work all over the property. How have you minimized this in areas where you can't deny it? Is TV internet something you negotiate on for a bundle, or does it become a profit source? So the answer to that really is it depends. Going back to what Neal said, each asset is so different. We've had an asset before where we've had to inherit cable contracts or internet contracts. Our asset yesterday, we had to inherit them, and we're still in the process of getting them switched over because they didn't do it properly. We all hate all internet providers. We hate all of the cable providers. I think, honestly, it's one of those things you're just kind of at the mercy of the provider, unfortunately. You will see an additional revenue item, though, or an additional income item a lot of times, and you'll want to negotiate this on your PSA. If you guys can't tell, I do a lot of the PSA negotiating, but you'll want to negotiate maybe to take a portion of it, but the cable company will oftentimes pay for an easement. Or they'll pay you per door to be the provider for the asset, and they'll oftentimes do like an upfront one-time payment of $1,000 a door. So if you have 100 doors and now you're buying the property 5 years into and it's a 10-year term, and you're buying it 5 years into the term, you'll want to make sure you ask for the proration on that too. I know that's not what you were asking, Ruben, but I just want to throw that out there because it's something, again, that gets overlooked. And every dollar of income that you add to the property makes a huge difference in valuation because you're anticipating an exit cap of X, Y, and Z %. So it's not just dollar for dollar, it's an exponential return on every dollar that you get back into the asset.
Yeah, and nowadays with the smart home stuff, I've seen some providers that do fiber optics, and then you actually become the internet provider.
Yep.
So instead of using Z-Wave, they use actually Wi-Fi, and you can revenue share that, and that's a good way to get rid of people with satellite dishes, because if you can offer
Yes.
an amenity with no setup, it's included, and it's less than the satellite, number one, you make more money.
Yep.
Number two, you don't have satellite dishes all over your property.
Yeah, and smart home features are becoming so popular. All of our assets, one of our assets that we closed earlier this year, were 100% like electronic keys. And it is just an awesome feature. The millennial tenants love it. They're willing to pay $50, $80 for smart home features like Nest and Google Homes. And for us, we're like, well, you can buy it for much cheaper than that, but they don't care. They want the convenience of moving in and then picking up and moving out. And so, yeah, smart home, all of these tech plays, I think we're going to see a lot more of those as asset management kind of evolves and shifts over the next few years.
Definitely. Well, that's all the time that we have. Great session. Thank you all so much. So much information. I know, especially Neal and Veena, when you're in a deal, this stuff is just right there on it. So been there, love it. Congratulations on the close of the new property, and thanks for being with us today.
Thank you so much for having us.
All right, and Neal, get some rest, man.
Yeah, I'm ready.
All right, y'all, have a great day.
All right, we'll see you at the next conference.
Sounds great.
Thanks. Bye.
All right, everyone, thanks again for joining us for that session. Veena and Neal talking about asset management. A lot of good knowledge there. You learn. Neal said, you're not going to be perfect. You're going to make mistakes. So, be well capitalized, underwrite well, have reserves. That's the key to that game. So be sure to be right back. We have one more session of the day. So you guys have been hanging in with us all day, hanging strong. We're almost on the home stretch. So be sure to check out or register for our next MFIN seminar or summit at nextmfin.com. Also go to the podcast and post a review. Send a screenshot to Stacy at multifamilyinvestornation.com. And also be sure to check out all the rooms you can. So coming up next, we have Kathy Fetke talking about market cycles. So that's going to be important. We are on a historically the longest upcycle in history in the U.S. And so this is a very important topic this day and age, market cycle. So be sure to join us back here at 5 p.m. just in about 12 minutes. So we'll see you in a few.